Hello, teacher. Welcome to our group presentation about investment thesis and recommendations for Brambles and REA Group. First is our investment thesis. Our investment thesis is based on an hantavirus-related public health scare. We are not forecasting a full-scale outbreak in Australia. Instead, the shock is short-term change in consumer behavior caused by a public health concerns. Our thesis is that this scare may shift the demand away from property activity and toward essential good. Therefore, our group recommends a long position in Brambles and a short position in REA Group. Based on the final models, Brambles has a discounted cash flow at estimated value of $19.60 compared with the current price of $15.74, giving around 25% upside. Our group has a discounted cash flow estimated value of $101.01 compared with the current price of $154.41, implying around 35% downside. And next, this slide explains the transmission mechanisms of our thesis. A hantavirus-related public health scare may change consumer behavior through two channels. First, in the property channel, consumers may reduce non-essential physical activities such as property inspections and auctions. This can lead to fewer new listings and weaker property advertising demand, which is negative for REA Group because REA's business is closely linked to the online property listings. Second is the essential goods channel. A household are likely to prioritize groceries and daily necessities. This keeping grocery and consumer staples supply chain resilient, which support Brambles' pallet and supply chain platform.
Thank you, Quinn, for introducing the thesis. My name is Linh, and now I will present our by recommendation on Brambles Limit. Bramble is a global supply chain logistic company operating across more than 60 countries through CHAP and IFCO, specializing in reusable pallet and container pooling solution for FMCG and grocery supply chains. Our investment thesis is that post-pandemic inventory behavior continued to support logistic demand, so Brembo's share price increased significantly from around $10 in 2020 to about $25 in 2025, reflecting stronger pallet demand and improving utilization rates after the COVID. In addition, around 85% of Brembo's revenue come from the defensive FMCG and the grocery sectors, providing stable recurring cash flow even during the economic uncertainty. Now moving to valuation, our DCF model estimated an intrinsic value of approximately $96 per share, compared with the current market price of around $15.74, implying approximately 25% upside potential. This valuation is supported by a WTC of 6.27% and a terminal growth rate of 4.5%, which we believe are reasonable assumptions given Bramble's stable cash flow profile and defensive business model. In addition, our forecast shows continued growth in free cash flow, supported by improving pallet utilization and ongoing global logistic demand. The sensitivity analysis also demonstrates that Bramble continues to show attractive upside across most realistic scenarios. Overall, Bramble offers strong cash flow generations, defensive earnings, and attractive valuation upside. And now we will present the stock we recommend selling.
Thank you, Lynn, for the evaluation of Brambles. RA Group is a digital property advertising platform, with residential contributing the majority of revenue. However, recent data show a more challenging property cycle, with buy listings and rent listings both weakening. This matters because RA's revenue is closely tied to listing volumes. The RBA's COVID consumption analysis suggests that a health shock will shift behavior away from physical activity and toward online activity. For REA, their online traffic may remain resilient, but housing transactions can be delayed. While this effect is likely temporary, as listings had evidently recovered after COVID, today's higher rate environment and mortgage pressure could amplify the short-term downside. Turning to valuation, we use a WACC of 8.7% and a terminal growth rate of 2.5%. REA's strong cash position and low debt to asset ratio greatly reduce their balance sheet risk. Our DCF gives an estimated share price of $101.01 compared to the company's current share price of $154.41. This implies a 35% downside. Free cash flow is expected to grow with the net income, supported by REA's strong operating performance. However, capex and depreciation also increase as REA continues investing in technology and platform maintenance, while interest expense remains relatively flat due to low debt. Finally, the sensitivity analysis supports our sell recommendation, as most scenarios that could occur from the shock remain below the current share price.
And that is the end of our presentation. Thank you for listening.